Mortgage and financing involve a range of concepts and terms that are important to understand. When you're buying a home or considering other types of loans, it's good to learn about these. Here are some general concepts and terms related to mortgage and financing. Mortgage. A mortgage is a loan used to buy a home or any form of real estate. A mortgage is a loan specifically used to purchase real estate. The property itself serves as collateral for the loan. The loan is paid back over time, and the home or real estate serves as collateral for that mortgage loan. If the borrower fails to pay back the loan or defaults on payments, the lender has the right to repossess the home or property. There are a variety of loan products that are available to borrowers. It's important that the buyer choose a loan product that aligns with their financial situation. To do otherwise could lead to defaults on the mortgage payments, and ultimately, a loss of the real estate purchase. Mortgage bankers. Mortgage bankers are lenders who originate, process, underwrite, and close mortgages, typically using their own funds. Mortgage bankers primarily make money on the fees associated with the origination of the mortgage loan. They might retain the mortgage or sell it to another investor. Mortgage brokers. Mortgage brokers are intermediary parties that bring together borrowers and lenders. Mortgage brokers originate and process loans only. The broker typically has experience aligning mortgage loan products and programs to a borrower's finances and needs. The broker makes a commission on the transaction at closing, paid by either the lender, the borrower, or both. Financing. Financing is simply a way of paying for something. In real estate, financing is typically discussed in association with making payments for homes or other forms of real estate. Usually, financing requires securing a loan from a lender, such as a mortgage. Collateral. In real estate, collateral typically refers to the home or real estate purchased by the borrower of the loan. If the borrower defaults on the loan, the lender can repossess the home or property as compensation. Closing costs. Closing costs are the fees associated with finalizing a real estate transaction. They include items like appraisal fees, title insurance, and attorney fees. Credit report. A credit report shows a breakdown of a person's credit history, or how a person has repaid loans in the past. This can be major loans for such things as cars or education, or it can be monthly credit card payments. In mortgage banking, a tri-merge credit report is used, which is different from the consumer version of a free credit report, as tri-merge report pulls credit scores from all three credit agencies. Credit score. A credit score is a numerical representation of your credit worthiness. Lenders use it to assess the risk of lending to you and determine your interest rate. A credit score is what's assigned based on a person's credit report. A higher credit score is achieved by a history of timely, consistent payments on past loans. Higher credit scores make it easier to not only secure mortgage loans but also better terms for the loan, as the person with a higher credit score is deemed a lower risk for defaulting on the loan. A lower credit score is often assigned to those who have a history of inconsistent or missed payments on loans. Lower credit scores make it more difficult to secure mortgage loans and as well as advantageous terms for loans that are secure because the person is deemed a higher risk for defaulting on the loan. Because the lender is taking on more risk, by lending to a person who is deemed a higher risk to not pay off the loan in a timely manner at all, they require higher interest payments to compensate. Credit Bureau. Credit bureaus collect the credit histories of consumers, which ultimately result in the person's credit score. There are three major credit bureaus operating in the United States: TransUnion, Equifax, and Experian. Ultimately, these agencies are the arbiters of a person's creditworthiness, which in real estate means how appealing they will appear to mortgage lenders. All three agencies collect similar information about consumers that results in similar credit scores, but there are differences that will result in some differences in credit scores. Points, also referred to as discount points. Points are a way for borrowers to pay down interest on a mortgage loan in advance. The prepayment then lowers the interest on mortgage payments thereafter, resulting in lower monthly bills. Each point is typically equal to approximately 1% of the total loan amount, and each point generally reduces the interest rate by about 1/8 to 1/4%, depending on the borrower and overall terms. Down payment. The down payment is the initial payment made when purchasing a home. It's typically a percentage of the home's purchase price. A larger down payment can result in a lower mortgage amount and potentially better loan terms. Escrow. Escrow is a financial arrangement in which an account is set up between borrower and lender that distributes bundled payments for mortgage principal, mortgage interest, property taxes, and hazard insurance. Bundling these funds in escrow helps ensure that all bills will be paid on time. The payments are adjusted over time to account for changes in insurance, property tax assessments, etc. Some mortgage loans require escrow accounts established. An FHA loan typically requires escrow accounts, for example, as does home purchases with less than a 20% down payment. The term escrow is also used when a buyer is giving earnest money to show a seller they are serious about purchasing a home. That earnest money is held in an escrow account, or a mutually agreeable third-party account, until the transaction is finalized. Earnest money deposit, EMD. Earnest money is an initial deposit made by a buyer to show the seriousness of intent to purchase a property from a seller. The deposit is held in an escrow account and is typically equal to 1% to 3% of the total purchase price at a minimum. Equity. Equity is typically understood as the value that a person or business would receive in return for the sale or liquidation of an asset. In real estate, equity is typically the amount of money a home or property owner would receive after all remaining debt and costs were paid of the sale of the home or property. It's the difference between the value of the property and the amount owed. Principal. Principal is the amount outstanding on the loan, minus the interest, that is, the amount of the actual home or property, that has not yet been paid. Fixed-rate mortgage. In a fixed-rate mortgage, the interest rate remains constant for the entire loan term, providing predictable monthly payments. Debt-to-income ratio, DTI. It is a measure of your debt relative to your income. Lenders use it to assess your ability to manage additional debt. Gross monthly debt payments divided by gross monthly income. DTI is expressed as a percentage and is used as a primary factor by lenders in determining mortgage loan eligibility. Gross monthly debt is the total of housing debt, rent or mortgage principal, interest, taxes, auto debt, credit card debt, student loan debt or any other monthly debt payments on a buyer's credit report. Gross monthly income is their annual income divided by 12. For example, if someone pays $3,800 a month for their housing, credit card payments, auto and student loan, monthly debt, and their monthly income is $8,333, $100,000 income a year divided by 12, their DTI would be 45.6%. $3,800, monthly debts, equals 45.6% $8,333, monthly income. Mortgage interest. Mortgage interest is the amount of money charged on a mortgage loan above the purchase price of the home, or the principal. The majority of the early mortgage payments go towards the interest rate. In this way, the lender is paid off early, leaving the principal, that is, the actual price of the home or property, for the later payments. Interest rate. The interest rate is the amount a borrower is charged for a loan over time. Interest rates vary over time, so it benefits the borrower to monitor interest rate trends, in an attempt to lock in the best rate for the time period that best aligns with their financial needs. The interest rate is the cost of borrowing money, expressed as a percentage of the loan amount. It significantly affects your monthly mortgage payment and the total cost of the loan. Default. Default occurs when a borrower fails to make the required payments on a loan. It can lead to foreclosure in the case of a mortgage. Annual percentage rate, APR. The annual percentage rate, APR, is the total rate of interest, on an annual basis. APR is often conflated with interest rate. APR includes the interest rate and also interest on all the fees and costs associated with a loan, such as points, brokerage fees, and any other charges. Because APR accounts for all of the interest on these additional costs, it is a truer measure of what interest the borrower is paying on an annualized basis than the interest rate alone. APR can be a useful tool in comparing loan terms from different lenders, but it can only be used to compare the same loan types. Adjustable rate mortgage, ARM. An ARM has an interest rate that can change periodically, often after an initial fixed rate period. The rate adjustments are typically based on a specific index. Amortization. Amortization is the process of paying off a loan over time through regular, equal payments. Most mortgages are amortizing loans, meaning you pay both principal and interest with each payment. Escrow. An escrow account is set up to hold funds for property-related expenses, such as property taxes and homeowners insurance. A portion of your monthly mortgage payment may go into the escrow account. Home equity. Home equity is the value of your home minus the remaining mortgage balance. It represents your ownership stake in the property. Refinance. It is the process of replacing a current mortgage loan agreement with a new agreement, typically one with better terms for the borrower. A borrower might pursue a refinance of a mortgage when mortgage interest rates drop substantially. It's important for borrowers to understand that there are closing costs incurred associated with refinancing. Likewise, a reset of a mortgage agreement has the potential to extend the repayment period such that a lower rate might end up costing the borrower more over a longer repayment period. Home equity line of credit, HELOC. HELOC is a credit line that's taken out using the home as collateral. After an appraisal, a lender will extend a homeowner a line of credit based on the equity that has been built up through mortgage payments. Typically, a person can borrow up to 80% of the difference between the value of the home and what the borrower still owes. The difference is what's considered the equity. So to open a home equity line of credit, the price of the home must, first and foremost, be valued more highly than that is owed. Interest rates for HELOCs are typically lower than interest rates for other lines of credit, such as through credit cards or other loans. Lock, or mortgage rate lock. A lock is what the lender guarantees the interest rate to be on the mortgage for the borrower at the time of closing. The lock does not mean, however, the loan is then guaranteed to the borrower, only the rate is guaranteed should the loan be finalized. Rate locks are only good for a certain period of time, 30, 45, or 60 days. If the property does not close on time, and the rate expires, the borrower may be charged a fee to extend the rate, or they will be subject to whatever the current rates are at that point. Loan-to-value ratio, LTV. The LTV ratio is the ratio of the loan amount to the appraised value of the property. A lower LTV ratio often results in better loan terms. Loan term. The loan term is the period over which the loan is repaid. Common mortgage terms are 15, 20, or 30 years, but other terms are available. Loan origination fee. This fee is charged by lenders to cover the cost of processing a loan application. Private mortgage insurance, PMI. PMI is required by lenders when the down payment is less than 20% of the home's value. It protects the lender in case of borrower default. PMI is an additional mortgage insurance borrowers have to pay when making less than a 20% down payment on a home purchase. The policy covers the difference between the percentage the borrower put down and 20% of the overall sales price. This form of insurance is meant to protect the lender, rather than the borrower, or the person who purchased it, but it does allow borrowers to perhaps purchase a home that they would otherwise be unable to afford without PMI. Principal. The principal is the original amount of money borrowed in a loan, excluding interest and other fees. As you make payments, a portion goes toward reducing the principal balance. Pre-approval. Pre-approval is a lender's conditional commitment to provide a loan based on a preliminary assessment of your creditworthiness and financial situation. Rescission, or right of rescission. Rescission is the right of a borrower to cancel and refinance or home equity line of credit, HELOC, within 3 days of closing on the transaction with a new lender. The law was enacted to protect consumers against predatory lenders. The 3 says serves as a cooling-off period that allows the borrower to perhaps think more clearly about their commitment and change their mind if need be. Importantly, this law applies only to refinancing with a new lender, not the borrower's existing mortgage lender, and it does not apply to the purchase of new homes. Refinancing. Refinancing involves replacing an existing loan with a new one, often with better terms. It can help lower monthly payments or reduce the interest rate. Underwriting. Underwriting is the process by which a lender evaluates a borrower's creditworthiness and risk to determine whether to approve a loan. Understanding these concepts and terms is crucial when navigating the world of mortgages and financing, as they can impact your financial well-being and the overall cost of homeownership or other types of loans.